In February 2026, Marc Benioff announced that Salesforce would hire 0 software engineers this year. Not a slowdown. 0. AI agents are doing the work, he said. This is the same man who named a skyscraper after himself and spent 3 years screaming about returning to the office. He's now saying engineers are optional. The skyscraper is still there. The engineers are optional. And right now, today, Brent crude is trading above $100 a barrel. The US-Israel strikes on Iran, launched February 28th, pushed oil up 40% in a month. Goldman Sachs has raised US recession risk to 30%. US inflation is heading back to 4%. Trump, asked about rising gas prices, said, quoting directly, "If they rise, they rise." That's the energy policy. If they rise, they rise. Which is also coincidentally what's happening to your cost of retraining for a new career. Now, every YouTube channel right now is telling you to quit your job and start an AI agency. Start dropshipping, build a personal brand, sell courses about selling courses. The 9 to 5 is dead. Be your own boss. Freedom, baby. I'm going to do the opposite, because while those guys are selling you an exit, the actual data is telling a different story. One about what happens to the salary you have right now, in the job you have right now, whether you quit or not. And that story is more important, more specific, and more actionable than anything a $997 course will tell you. This isn't a video about whether disruption happens. It's about what you do with your money while there's still time, and the answer is more specific than you've been told. Subscribe before we get into it. Not because I need the number, because if this kind of thinking is useful to you, you should know when the next one drops. In about 4 minutes, I'll show you the scenario where nobody in your office loses their job. Nobody gets made redundant, nobody has to retrain, and your lifetime wealth still takes a $280,000 hit. Hold that. But first, let's go back. Way back. Every civilization in human history has had its automation moment. The moment when a new technology made a huge chunk of the existing workforce structurally unnecessary. And every single time, the pattern was identical. Agricultural revolution. Before it, almost everyone farmed. After it, farming required a fraction of the people. The people who survived? The ones who owned the land, the asset. The ones who owned nothing but their labor were displaced, resettled, or subjugated. Industrial revolution. Before it, craftsmen made things by hand. After it, factories made the same things in volume at 1/10 of the cost. The people who survived? The factory owners. The capital. The people who were pure labor. The weavers, the spinners, the handsmiths spent decades fighting for wages that machines were constantly undercutting. The digital revolution. Before it, humans processed data by hand. Bookkeepers, actuaries, telephone operators, typists, entire professions whose core function was structured information handling. After it, computers did that work. The people who survived, the ones who owned software, equity, platforms, shares in companies that built the tools, the people who were pure knowledge labor, who showed up to process information and left with nothing else, found that their specific skill was worth less every decade. Here's the pattern across 3,000 years of technological disruption. Asset owners survive, pure laborers get displaced, every time, no exceptions. Now here's what's different about the AI civilization: the speed. Agricultural revolution took hundreds of years to fully play out. Industrial revolution took 80. Digital revolution took 30. AI? The people who built it, including Carpathy, the former AI director at Tesla, say the industry has realized less than 10% of the potential of these systems at current capability. We're at 10%, and the transitions are getting faster with every cycle. If the last revolution took 30 years, and each one is accelerating, a 10-year disruption window is not conservative. It may be generous. Like this video if you just felt that in a way that was unpleasant. That's the appropriate response. The entry-level collapse is already happening. This is the leading edge. Since January 2023, entry-level job postings have fallen 35%. Entry-level tech hiring dropped 60% since 2022. In the US right now, computer science graduates are running 6.1% unemployment, nearly double the rate for philosophy majors. The philosophy major won. They've been quietly winning since 2023. Nobody told them. They're still reading Nietzsche, completely unaware. Subscribe if you're a philosophy major feeling extremely vindicated. Also subscribe if you're a CS grad. Especially subscribe if you're a CS grad. IBM replaced 7,800 HR roles with AI. Their system now handles 94% of routine HR tasks. Salesforce announced over 1,000 new salespeople this year while hiring 0 engineers. The career ladder hasn't disappeared. The bottom rungs have. This is also, broadly, how DOGE approached the federal workforce in 2025. Bottom rungs first, same energy, different spreadsheet. That matters even if you're 20 years in. Those bottom rungs were where people learned the craft. Junior lawyers doing document review, junior analysts building models, junior accountants reconciling ledgers. AI is doing that work now. The people who would have spent 5 years learning by doing aren't building that experience. The pipeline gets thinner, salaries at the top may hold, the middle compresses, and recessions accelerate this. Every major economic shock of the last 30 years, 2001, 2008, 2020, was followed by companies using the downturn to compress headcount and automate what they previously hadn't justified. If Goldman's recession call is right, 2026 becomes the year AI adoption doesn't slow down. It speeds up. The oil shock and the AI shock aren't pulling in different directions, they're pulling together. You're probably somewhere in the middle of a knowledge work career. Not at the start where you can rebuild, not near the end where your assets are set. Right in the zone where a 10-year disruption catches you at the worst possible time, arriving into an oil shock, not a boom. The conventional wisdom says, adapt, learn AI tools, stay relevant. That's not wrong. PwC's 2025 Global AI Jobs Barometer found workers with AI skills now earn a 56% wage premium, up from 25% just 1 year earlier. Jobs requiring AI skills grew 7.5% last year, while total postings fell 11.3%. The skills premium is real. There are currently 47 LinkedIn thought leaders posting this week that AI is a tool, not a replacement. Most of them are consultants. Some used ChatGPT to write the post about AI not replacing them. This is fine. This is the economy now. But something else is happening that the Learn AI advice doesn't address. The productivity gains are real. They're just not going to workers. When AI lets one analyst do the work of 2, companies don't split the difference. They keep the margin. Labor's share of national income has been falling for decades, and AI is accelerating the split. A financial analyst whose role gets restructured around an AI co-pilot may take a 20% pay cut, even if she keeps her title, her desk, and her LinkedIn headline that still reads Senior Analyst. She didn't lose her job. She lost a fifth of her earning trajectory, and she probably won't see it clearly for years. Stop. Before the numbers, one framing shift. This is the most important thing I'll say. Your salary is an asset, not a given, not background income. An asset, just like the ones in your investment portfolio. Here's how to think about it if you're 10 years old. Imagine you have a lemonade stand that makes $50,000 every year. If someone asked, what is that lemonade stand worth? You wouldn't say 0 just because you haven't made the money yet. You'd say it's worth all the future $50,000 added up, discounted for time, but still enormous. That's the net present value of your salary. For most knowledge workers, when you add up all the paychecks you haven't received yet, that number is between 2 and 4 times everything in your bank account, your super, and your investment portfolio combined. Your salary is your largest asset, and it is entirely unhedged. The pattern across every civilization. Asset owners survived. Pure laborers got displaced. If your salary, your labor, is your only asset, the historical track record is not encouraging. If that framing just landed differently than you expected, the idea that your salary is a concentrated single asset risk, subscribe. This is what we do here. Scenario 1, the bear case. 5% of white-collar roles displaced over 10 years. Most people adapt. AI makes workers more productive rather than redundant. Here's what happens anyway. One analyst starts doing what previously took two. Employers need fewer new hires to grow. Junior positions shrink. The salary you expected to reach by year 5 takes 8 years. A $100,000 role expected to grow to $130,000 by year 5. Under wage compression, it reaches $115,000. That's $15,000 a year. Over 10 years before compounding, $150,000 in lost expected income. If the difference had been invested at 7%, the real cost is $207,000. Nobody got fired. The job still exists. The wealth destruction is invisible on any single pay stub and enormous over a decade. Scenario 2. The base case. 20% displacement of affected white-collar roles by 2034. Broadly in line with Goldman Sachs, the WEF, and Anthropic's own research. The WEF's 2025 Future of Jobs report forecasts 92 million roles displaced globally and 170 million created. A net gain that is real and cold comfort if you're in the 92 million. Goldman puts 25% of all current US work hours as automatable with models available today. Jobs exist, but the ratio of candidates to open positions shifts. Wages compress 20 to 25% in the most affected categories. Career transitions become necessary at exactly the point in most people's careers when a transition is maximally disruptive. Same $100,000 salary. Role wages compress to $80,000 over 8 years. That $20,000 annual gap over 8 years. $160,000. Add compounding at 7%, $230,000. Now add the current backdrop. US inflation at 4% means that $160,000 in lost earnings is worth even less in real terms. Your real savings rate is being compressed from two directions simultaneously. The wage compression curve on one side, the oil shock on the other. Scenario 3. The bull case for disruption. 35% displacement. Not just junior roles, mid-management, knowledge synthesis, and large chunks of what currently passes for strategic work. That is, at its core, structured analysis and communication. Here's the number that splits the two groups. Someone earning $150,000 a year who maintained a 20% savings rate for the 10 years before disruption has $417,000 in invested financial assets at 7% returns. Enough runway to navigate a 2-year career transition without touching their retirement account, without selling their house, without making a panicked financial decision. Someone earning the same $150,000 with a 5% savings rate has $104,000. Same salary, different conversion rate, completely different outcome. And the outcome was locked in years before the disruption arrived. If you just did that math in your head and it did not go well, comment 104 below. Nothing else. I'll know. Mechanism 1. Human capital concentration risk. Financial advisors spend a lot of time on portfolio diversification. Almost none of them help you with the bigger concentration problem. 90% of your total wealth sitting in one employer, one role, one sector. Here's how to think about it if you're 10 years old. Imagine you have a piggy bank. Inside that piggy bank is one massive gold coin. That's your job, your future salary, your biggest asset. And around it, some pennies, nickels, dimes. That's your savings and investments. The entire financial advice industry spends all its time telling you how to arrange the pennies. Nobody mentions the gold coin has a crack in it. Your human capital is an asset class. It earns returns, it carries risk, it can be hedged. Most financial plans treat it as fixed, because they were built around the assumption that employment income is stable. That assumption is being tested now in a way it hasn't been since the 1970s, from two directions at once. Mechanism 2, the wage compression curve. Disruption doesn't arrive on a day. Wages compress before displacement, sometimes years before. As AI raises productivity per person, the case for adding headcount weakens. Companies book the margin, workers keep the title. Here's how to think about it if you're 10 years old. Imagine you mow lawns in your neighborhood for $20 a lawn. A new kid shows up with a riding mower that does the same job in half the time.
You still have the job. The lawn still gets mowed. But what your hour of work is worth just dropped. Not because you got fired, but because the riding mower changed the market rate for lawn mowing. That's wage compression. And you won't notice it on any single lawn. You'll notice it when you try to buy a house in 8 years. The PwC numbers are worth sitting with. Industries most exposed to AI are seeing 3 times higher revenue per employee than the least exposed. That revenue goes somewhere. Historically, when productivity and pay split apart, it goes to shareholders, not workers. Your salary still goes up each year, just slower than it would have. And if U.S. inflation is running at 4%, the real value of that slower raise is shrinking. The gap is only visible over a decade, by which point the window to act is already closed. Mechanism 3. The asset conversion window. Between now and the point when AI meaningfully hits your sector, there is a window. During this window, your human capital can be converted into financial capital at its current value, before the compression arrives. Here's how to think about it if you're 10 years old. Imagine you collect baseball cards. You find out that in 3 years, the company that makes them is going out of business, and the cards will be worth almost nothing. Right now, your cards are worth $100 each. The window is the time between now and when the price collapses. If you swap your cards for cash, or invest them in something else, during the window, you come out fine. If you wait until the price drops to see if you really believe it's going to happen, you lose everything. The window doesn't reopen. One more thing about this window. Karpathy has described how AI capability is jagged.
Reinforcement learning is terrible. It just so happens that everything that we had before is much worse.
These systems pass the bar exam and then fail to count the letter R in the word strawberry. In 2024, this became a famous meme. Everyone laughed at the strawberry problem.
In the word strawberry, there are actually 2 R's.
In 2025, Salesforce announced 0 engineering hires. The strawberry problem is still there. Nobody cared anymore. The tasks AI automates aren't always the ones you'd predict, which means you can't reason your way to safety by identifying which parts of your job feel human. You have to assume more is at risk than seems obvious, and act accordingly. The window closes. The people who moved early are now financially independent of whoever employs them next. The people who spent the window on lifestyle are job-dependent in a market where that dependence is getting more expensive by the week. Run all 3 scenarios back. In every single one, bear, base, bull, the people who come through financially intact share one thing. They converted salary into financial assets before the disruption became obvious. In the bear case, they end up wealthier than their peers for a reason that didn't seem necessary at the time. In the base case, they have the runway to move on their own terms, not under financial pressure. In the bull case, they are functionally independent of whoever employs them next. The people who waited to see how bad it would actually get, to be sure before acting, are worse off in every scenario. Not because they were wrong, because waiting has a cost, and the cost compounds quietly. The best time to start was 10 years ago. The second best time is now. The third option is to close this tab, go back to the quit your 9-to-5 content, and wonder why your net worth looks the same in 5 years. Don't be third. History tells us what companies do when a recession coincides with automation technology. They don't pause to protect headcount. They use the downturn to justify what they were planning to do anyway. Everyone who posted, "AI will never replace the human touch" in 2022 is now using Claude to write their LinkedIn posts about AI not replacing them. The recursion is genuinely beautiful. I respect it.
Look at those.
There is no version of this analysis where building financial assets faster was the wrong call. The three scenarios differ only in how much it matters, not in which direction it points. This is the Career Hedge Triangle. 3 questions. If any one of them has a bad answer, that's where to start. Question 1. What percentage of your total wealth is dependent on your employer? Add your financial assets. Then estimate the net present value of your remaining working years at your current salary. What percentage is that second number? Above 80% means you are under-diversified, regardless of how your investment portfolio looks. Question 2. Which parts of your current role can't be described as template filling? Think about work that actually requires relationships, where someone trusts you specifically, built over years. Judgment in genuinely novel situations. Managing people through genuinely hard things. That's where the moat is. Everything else is a commodity that gets repriced, usually without warning. Question 3. What is your current asset conversion rate? What percentage of your income is becoming a financial asset this year? 10% is survival, 20% is a hedge, 30% and above is optionality. Your future isn't entirely determined by the value of your next employment contract. Every percentage point you move upward now, while the window is open, is leverage. The triangle. Financial assets, skill moats, income diversity. You don't need all 3 to be excellent. You need none of them to be 0. Want a worksheet version of this? Actual cells to fill in, formulas that run the math for you? Comment triangle below. Enough requests and I'll build it. That's also just how I decide what's worth making next. The agricultural revolution took hundreds of years. The industrial took 80. The digital took 30. AI is moving faster than all of them. Andrei Karpathy, one of the people who built this technology, says the industry has realized less than 10% of its potential at current capability. In May 2025, Anthropic's CEO said AI could wipe out half of all entry-level white-collar jobs. Microsoft's AI chief said most professional tasks will hit human-level performance within 12 to 18 months. Goldman Sachs says 25% of US work hours are automatable with tools that already exist. Oil is at $100. US recession risk is at 30%. The 2 largest disruptors of knowledge work in a generation are arriving at the same time, into an economy that didn't have great shock absorbers to begin with. The pattern across every civilization says the same thing. The asset owner survives. The pure laborer gets disrupted. The only question is which one you are, and whether you still have time to change the answer. If you made no changes to your financial position for the next 5 years, same savings rate, same asset allocation, same dependence on one employer in one sector, where would you actually be? Not in theory, your actual numbers, your actual runway. That's worth figuring out now while you still have time to change the answer. And if this landed, share it with someone who's still being told to just quit their job. They deserve the other side of that conversation.